Hey everyone, happy Thursday, September 12th. It's time for another market update. You're getting this on Thursday, September 12th, but I'm actually recording it Wednesday evening about 5:45 on the West Coast. I'm traveling tomorrow, but I wanted to make sure I got this video out to you guys because it was an important week. We got the Fed rate cut coming up next week on September 18th, and there was some jobs reports and inflation report coming out this week that was going to go a long way to determining, what the Fed's going to do at that meeting. So let's get right into it. First thing we got going back to last Friday, actually, was we got the August BLS Jobs report. We know this is a big one. This is one that's hurt us over the last couple of years. Often comes out higher than expected, and then later on they make negative revisions. Same thing, but this time it actually came in lower than expected. Came in at about 142,000 jobs created. Expectation was about 160,000. They did make a 3-month revision. I think a total of 144,000 jobs. Job creations they took away from these reports. And unemployment dropped a little bit. Unemployment went from 4.3 to 4.2. So let's take a closer look at this in graph form at least. Up from July's numbers, up from June's numbers, but still below expectations. Part-time work was up 527,000 jobs, full-time down 438,000 jobs. So again, a sign that this job market isn't as strong as people thought it was. Average hourly earnings was up a little bit, and average weekly earnings was up a little bit. So that's something the Fed pays close attention to. That's wage inflation, another form of inflation. They don't want us all making too much money because then we'll spend too much money. But overall, this was a good jobs report. It didn't go above and beyond and make it crazy that, oh yeah, they're going to cut a half a point, but also didn't get the market spooked out that maybe they wouldn't cut it all. So kind of what we needed, kind of what we expected. Markets reacted positively, so that was good to see. Next thing we got today, actually, we got the August CPI inflation report. The Fed's favorite form of inflation is the PCE report, but this is another one they pay close attention to. We all pay close attention to, and that came in about as expected. Headline was up 0.2% month over month. Core was up 0.3% month over month, a little bit higher than expected. Year over year, the headline is now down to 2.5%, which I believe is the lowest since February 2021. Looking at graph form, you can see how much it went up and how much it's calmed down. So, we're down here at 2.5%. This core rate, which takes out, food and energy, that's at 3.2%. And a big part of that one in the CPI report is shelter cost. The cost of basically housing is way inflated. It's a big number. Annualized, I think it's closer to 5%, 6%, which is not what it is in the real world right now. So there's been quite a bit of lag in this the shelter aspect in these reports. So we can expect that to come down as it catches up with real time data. But overall, again, a good report to see. It wasn't a blockbuster report that would get the markets too excited, but it was also not one that came in hotter than expected, and maybe it would have put some, put a stop to the rally that we've had going. So, another good report, kind of what we kind of needed, not too crazy, but good enough. Initial jobless claims coming out tomorrow. The estimate is 227,000. Expect it to be somewhere around. It's just been about around 230 lately, so somewhere in that range. If it comes in really low or really high, that could maybe make the markets react a little bit. But that's something to keep an eye on because obviously the Fed's paying close attention to anything job related. So where does that leave us? Last week we were down to 6.35, which was a good number. After today, we're at 6.11 is the average conventional 30-year mortgage according to a lender survey. For top end borrowers, people really, really good credit, putting a big chunk down. But overall, it's just good to see the number, no matter where you fall on that spectrum, the number is coming down. So that's down almost a quarter of a point since last week. Keep in mind with the Fed rate coming up, there a lot of this it's already happening. We're already getting that. What we're going to see on the mortgage side is already happening in the rates. So don't expect when the Fed makes their cut, if they cut a quarter of a point, that 6.11 to drop down to 5.86 or whatever. But it will get some positive benefit. But for the most part, the mortgage bond market does not wait for the Fed to do what they're doing, and it's already kind of baked in there. But overall, really good to see a six, getting close to six. If we get a 5 in front of them, that'd be amazing. But important dates. So tomorrow we get PPI. That's a producer inflation. So CPI is consumer inflation. How much things cost us. PPI is how much is costing the people producing those goods that we buy. And then, like I said, next Wednesday is the Fed is the conclusion of their 2-day meeting. Right now we can take a look at the graph. It looks like the markets are saying 85% chance they cut a quarter of a point and 15% chance they cut a half a point. Obviously, a half point would be amazing. Looks like it's going to be this quarter of a point. I'm happy kind of to see that people aren't expecting this half point, because then if we only got a quarter point, then we'd maybe see actually, rates go up a little bit. So I feel like it's all kind of coming together where we want it. As far as these reports coming out, how we like to see them, and the Fed, on track. It looks like to at least make that quarter point rate deduction at their next meeting, and then who knows going forward at their next meetings, what we'll get. But overall, great week. Good to see rates coming down. Good to see getting close to that 5.99 number. Be great to see it drop below 6. But if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, guys. Thanks.